So the screen is visible. Mixed supplies. Following the discussion we had, we saw that someone can deal in both taxable and exempt supplies. That is what we saw. Like here, as you can see on the screen, a trader may be dealing in both taxable and exempt supplies, and this therefore implies that the trader is dealing in mixed supplies. Rwenzori mineral water is standard rated, so this is taxable, whereas animal feeds is exempt. So we are making use of that scenario where the taxpayer or the business person is dealing in animal feeds and mineral water. Let's just say it's a trader, and that's what they are dealing in. So in this circumstance, we shall say that the trader is dealing in mixed supplies. And what is going to be the implication? If the trader makes or deals in exempt supplies together with the taxable ones, that trader is not going to be able to claim a credit for all the input tax. He's not going to be able to claim all the input. However, we need to do the math. We need to look at the volume of taxable and exempt supplies. If we find that the taxable supplies are, let's say, 96%, that this person has 96% taxable mineral water, meaning that animal feeds are only 4% of the total supplies for the period, then 4% is very small and insignificant in the eyes of the tax law, the VAT law, and therefore the trader will be deemed to be dealing in entirely taxable supplies. And the implication of that is that the trader can now claim all the input tax. The trader can claim all the input tax. However, if it is the other way around, okay, if we find that the trader is having 96% exempt and 4% taxable, again, to mean that the trader is actually dealing in entirely exempt supplies. So the yardstick here is 5%. I'm using 96 and 4%, but I just want to be within the 95%. So if animal feeds is more than 95%, like the example I've given here, it's 96%, then the trader will be deemed to be dealing in entirely exempt supplies, and they cannot claim input tax. Actually, they are not even supposed to register for VAT. So, accounting for mixed supplies, is it different from accounting for exempt? I mean, accounting for mixed supplies, is it different from where the person is only dealing in taxable supplies? Yes, it's different. So if you find yourself that you are maybe having mineral water, you try to balance that 70% of the items we sell, mineral water, is taxable, leaving us with 30% animal feeds exempt. I'm just using animal feeds and mineral water just to paint a clear picture. So in this case, you are outrightly dealing in mixed supplies. Okay, because the figures are showing the exempt, actually, we would say the exempt supplies are more than 5%. That's it. If the exempt supplies are more than 5%, then the trader is dealing in mixed supplies, and therefore the accounting is going to be a little bit different. So how different is the accounting? On the side, we are saying that if the value of the exempt sales exceed 95% of the total sales exclusive of VAT in any tax period, you cannot claim credit for any input tax because you'll be deemed to be making exempt supplies, as I've mentioned, where the percentage of the exempt supplies now exceeds 5%, but less than 95%, then the trader cannot claim all the input tax on your inputs. You cannot claim all. You can only claim up to the percentage of your taxable supplies. Okay. So this will imply that the input tax to be offset will have to be apportioned using any of the apportionment methods. So there are basically two. We have the general apportionment method and then the alternative apportionment method, or the standard alternative method, SAM, okay, which you abbreviate as SAM. But of course, as you have seen earlier, this one must be used alternative apportionment method, which we shall abbreviate as SAM. But this one, you must get the approval. Standard alternative method. You must get approval from URA. So we shall start with the default one, which is the general apportionment method. Then we shall look at the circumstances under which we might use the standard alternative, the standard alternative method. As the word goes, alternative, eh? Yeah, but by default, the law designates the general apportionment method as the outright method to use in accounting for VAT for mixed supplies. So according to the general apportionment method, the input tax to be offset will be computed as A times B over C. Of course, if you're using the tax return, this is now a web-based return. Everything is calculated automatically. We are going to also go there and see, because actually the return clearly explains, clearly shows how these things, computed. Yeah, if I keep it here in the books, theoretically, you might get challenges if you have not filed this return before. So we are also going to look at the tax return. How is it? And we are going to compute following what has been laid out, the design of the return. So the A in the formula is the total amount of the input tax for the tax period. The B is the total value of the taxable supplies for the tax period, including zero-rated supplies. The C is the total value of all the supplies made during the tax period, including all exempt supplies, except any exempt supplies resulting from the transfer of a taxable business, but excluding any VAT. So the tax law clearly defines what is A, what is B, what is C. But under normal circumstances, I remember what you said, that the tax payable to URA, let me just take you back here. So it'll be just give me a minute. The tax payable to URA becomes the input minus output. Yes. Input minus output. So mixed supplies, there's just one extra step that we shall take. Tax payable to URA. Tax payable or claimable. If it becomes, it comes out as a negative, claimable, it is a negative, is output VAT minus the input VAT. Okay, that is how it looks on paper, written just like this. Tax payable, VAT payable, TRA, you get your output VAT minus your input VAT. So what we are doing here is the input that must be offset. So this A, ideally, is the total input, okay? Total input. So this fraction here is the apportionment. We are apportioning the B, the total taxable supplies over the total value of the supplies. So the B are the taxable supplies. The C is the total. And this C includes the exempt. So literally you are offsetting or claiming to the percentage of your taxable supplies. If your taxable supplies, as per the example I've given, is 70%, you claim this minus is up to 70%. If you are dealing in entirely taxable supplies, then this minus is 100 what? You claim 100%. So the more exempt supplies you have, the lesser of the input tax you can claim. Okay, the lesser is the input tax you can claim. Now let us just have a look as we go into the computation, because after this, I want to give you an exam type question. The exam type question that we are going to work on, we shall follow the design of the return. And of course, when you look at the past papers, at least some of the answers that have been shared with you, you'd see that the examiner is following the same format. Okay. Yeah. So let me see if I can access the return here quickly. We have a look, and then you'll appreciate my approach towards the calculation. Just a minute. Let me pause a bit here. Give me like 2 minutes. I'm going to be done with it. So, only one person is seeing the screen. Is the screen visible from your side? If it's not visible, I drop this part. We go straight to the computation. So this, okay. Hello? Is the screen visible? Okay. So, let's be as if we are filing the VAT return. So we come to e-services. I've logged in already. E-services, go to return, then you go to the VAT, monthly monthly value added tax. So when you click on that, you're going to be taken to the e-returns. That of course is the name of the taxpayer, the TIN, the business registration number, then the form. This is a form now, web-based monthly VAT return. So it is a monthly return. That's the first thing we notice here. Monthly return. So what does it mean? It means that the examiner should also maintain monthly what? Monthly return. Monthly return. To be very unfortunate if the examiner wants you to do annual return because the VAT return is a monthly one. Okay. So I'm going to select a period and that must be a month. From where are we now? We are Feb. Let me get because if I try to do Feb, it may, I might be filing before the end of the month. So let us check out January. The January was already filed, so we shall just view the return. So if I select first, I'll be automatically taken to the end date. I'll be taken to the end date. So it is loading. This is our return. How do I tell it's already filed? You will see that there is a word amended. Eh? If it is not yet filed, this one would be original. So this is telling me that this return has already been filed. However, it doesn't mean that I cannot amend this return. I can always amend it, but I'm not here to amend it. I just want to show you how the return is designed. Now, I'm going to, and then you can also see reason for amendment. I have to give reasons why I'm changing this return, but I don't want to do that. I just want to view it. So now I click on view, you see that all the other sheets are going to pop up. Let's see how they have designed the return. Taxpayer details, here you're able to see the return period, previous return date, whether it is original or amended. Tax computation summary. Let's look at this. On the tax computation summary, we have section B, tax computation summary, monthly VAT return. As you can see, indeed, the return has been designed in such a way that we have the total output VAT for the period that must be captured. Adjustment to output VAT, there's nothing. Net output VAT for the period. So what does it mean? It means that if the examiner gives you any information regarding the adjustments, you must come and do the adjustments. You may have the total output, then adjust it, then you get the net output. That is line 1 and 2 and 3. Then in line 4, you see we have the input tax allowed for the period. So the input is 6.1, output was 540. So the literal or straightforward interpretation of this is that this client, for the month of January 2026, made or collected VAT from sales of 540. There were no adjustments. The net output VAT was 540. So the client or this taxpayer made sales and the VAT resultant VAT was 540. At the same time, we see that the taxpayer was also charged VAT from their inputs to the tune of 6.1. So we net 540 minus 6.1. It gives us total VAT assessed for the period of negative 5.6 million. So his input is more than the what? Than the output. So he spent more than what he collected. So it comes out as a negative, and that's what we have referred to as VAT claimable. So he can claim this 5.6. We shall see that. Then below we have section B2, VAT liability on imported services. Now again, we see that in the summary, VAT on imports. Kindly re-explain which one? Which one? You can just tell me. Which one do you want? I can re-explain it, but I want to know which one you want to explain. You can even unmute yourself. Tell me which one I should re-explain. The whole thing. Okay. I was saying this is the summary. The summary. We shall also have our summary. Okay. As we move towards the computation, we're also going to have our summary. Let me make it better by starting with the cells. Cells. We shall have a schedule where we are going to compute our cells. In that schedule, okay, we shall have to capture the local exempt, local zero rated, export zero rated, local standard rated, local standard rated government supplies. We may not do this for our computation. We shall just, do the entire local standard rated, local VAT deemed. So the very first example we shall have, I'll first freeze the deemed part. Then I'll explain VAT deemed. Then we shall have it here. Out of scope supplies, we shall also have that. Now, for my client, as I was explaining under the tax summary, for this client, this is a client of mine. For my client, he made sales locally, local number 4 here, local standard rated. He made sales of 3 million. 3 million is a standard rated. This is a standard rated sale. 3 million. Now, 18% of 3 million is 540. You can even try it there, Gloria. 18% of 3 million is 540. So, as he made sales, he collected the VAT. And as you can see on the return, it is showing output VAT charged. This is automatically done. Remember, this return is connected to IFRS. So he posts this in IFRS, issues an IFRS invoice of 3 million. The 3 million drops in the main system, the tax system. Then they compute. Actually, in IFRS itself, you would see the 540. You will see the 540. So it means that this taxpayer issued an IFRS invoice of 3 million, of which 18% 540 is VAT. So 18% of 3 million, that's 540. This 540 is what you see in the tax computation summary here, 540. Are you seeing that, Gloria, now? I hope you're now clear with the 540. And even the rest, Juliet. Praise. Are we good, George? Are we good with the 540? Perfect. Now, let's go to the purchases. You've understood the sales part. So when you're making your computation, we expect you to show the sales schedule first. Don't mix them. Sales schedule. Show the local exempt, local zero rated, export zero rated, local standard rated, deemed out of scope. Now, let's go to the next sheet. This one, purchases. Under the purchases, again, you must show local, exempt, imports. Now, for purchases, you're going to have imports. Instead of the opposite of export, because now the export zero rated. The opposite of export is import. So export must be in the sales schedule. Import is in the purchases schedule. Now, purchases schedule, you get the import. So you can see we shall need to show all these systematically and smartly in our computations. Local exempt, import exempt, zero rated, local zero rated, imports zero rated, local standard rated, imports. You can see everywhere import, 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 import. As you're giving the local exempt, also show the import exempt. Local zero rated, import zero rated. Local standard rated, import standard rated. Local VAT deemed, import standard rated deferred. Out of scope purchases, purchases prior to VAT registration. Remember what we mentioned. When you have stock in hand, 6 months prior to registration, you can claim. Okay? So all these are present, but for our particular person, my client here, he didn't even, which I think he must. You see, this is a guy. I do work for him, but he's a guy who will tell you I didn't have any, I didn't have any local purchases, but what about water? What about electricity? What about, so because of the provision of amending the return, I usually, file these returns and then go back because I make a visit. I ensure that I visit the client, get to know, because some people will tell you I didn't have local purchases. I didn't have local, um, I didn't have local purchases. I didn't have expenses that have VAT. Speaking out of ignorance, in most cases, they don't even know. There is no way you can run a business without water, electricity, stationery, furniture. So they usually have those things, but they don't want to really dig. So for clients like this one, you can file the return, because if you don't file the return, then it's another issue. So you can file the return, then you come back and amend. So you may see it like this, but you'll find that maybe in March or April, I have amended almost the 4 months. I usually go back and amend like 4 months. Then if there is any resultant VAT, then it is paid. So let us make an assumption, unrealistic one, that he only had imports, which is showing me. And you know why these imports are here? Because this VAT, the 34 million, is captured at customs. There is no way you can defer, when it comes to imports, as you're bringing in goods, they go through customs. As you're paying your customs duties, you must also pay your VAT. VAT is part of the duties. So that's why it's very hard for you to skip or not record VAT resulting from imports. As you can see, he has imported goods worth 34.1 million. This is a standard rated supply. VAT imports, VAT, they are all standard rated. I hope you know that. We shall be talking about imports of goods and services. 18% of 34 million is 6.1. That is the 6.1 you have seen here. This one here. This is the one that Gloria is saying, repeat everything. So I hope you have now understood where the 6.1 is coming from. This is the input tax from schedule purchases. 6.1 comes now in the summary. So we shall also have a summary. That's why I'm showing you this return. As we are going into the computation, I'll first present the sales, I'll present the purchases, then I'll present the summary. Actually, I'll first go into the input allowed. Then I'll go to the summary. So it's not just a matter of calculating, and we want to promote not just the theory, but practically. What you're doing should reflect what is being done here. So that is where we get our 6.1. Now, let's go to input tax allowed. Why are we having this? We are having this because there could be circumstances where we have some exempt supplies, and that would need apportioning, mixed supplies. Now, for my client, he does not have any exempt for now, because I'm going to visit and, I may find some exempt. For now, as things look, no exempt. So he's going to claim 100% of the 6.1. So that's why you see here, we begin by selecting the method of apportionment. Now, you remember I've talked about the normal or default method. That's the general apportionment method, this one. Then we have the standard alternative method, the sum. Standard alternative method. This one, you don't just come and select it. You must have the approval of URA. And you must give reasons why you're using the standard alternative method. We shall be seeing that. So, as things look, the creditable input is 6.1 because we don't have any exempt. The rest of the details, I will encourage you to come and read through this return line by line, line by line, line by line. It's very important for you. So that is where the tax computation summary comes from. So at the end of the day, we subtract the 6.1 from the 540. That's why you see he has a claimable VAT. His position is claimable. He can claim this money. He can, because you can claim over and above 5 million. But that is on paper, in theory, that you can claim the 5.6. Claiming tax credits from URA is an entirely different thing. And if maybe time will allow us, I will show you. That will be a bonus. It's not the syllabus, but it will be a bonus if time allows. Okay? I will show you how the claiming process, the politics. Because at least I have been able to help more than 11 clients to claim from URA. Not 5 million. I do not engage myself with 5 million. You must be at least, your negative must be at least 500 million. It must be at least 500 million because I want 10%. When you get that money, I have my 10 and the standard. I think you'll ask around. So that is how things are. So at least 500 million. If you have 500 million, please contact me. I can get you that money in less than 3 months. Okay, if you have any client, they are claiming money from you, but you tell them ahead, my cut is 10%. So if it is a billion, you're claiming 1 billion from URA, my 100 million must be there and ready. I don't want those things. I get the money, then you take me through circles. So, and that's how things are. Some of you are studying this course, you don't know that it is decent. You earn decently. Just make your name. And don't study just to write exams but start now. I've kept on telling you to start tax consultancy now. Yes, don't wait. Start now. You'll get clients and you'll be shocked. So let us now go into the calculation. As we compute, I'll be following that. I begin with the sales, purchases, input claimable, then the summary. The first set of questions, they're about, let me see, they're about 3. I'll begin with the very first one. So I'm going to share these questions on the WhatsApp group. Don't mind about the month. It's a little bit 20. It's showing 2021, but we shall be using the current tax law. Just if it is 2021, we shall maybe put it around 2025, something like that, and then apply the current tax law. So we are going to begin with Kazinda, a businessman in Kampala. During the month of April 2021, he made the following transactions. Made sales of general merchandise amounting to 35 million. Sold fish from his stall in Chiseka Market, 40 million. From his farm in Kalaji, he sold 50 cows, 1 million each. Sold general merchandise to Moko Investments, 150. Exported fish to Rwanda, 300 million. Other transactions are given here. What are we required to do? We are required to, first of all, determine whether he's supposed to register for VAT. Then advise him on the VAT implications of the transactions in the month, and then advise him whether he has VAT payable or claimable for the month. Okay. Okay. So let me share this question. Guys, I've mentioned that you have to start, okay? You must wake up. I'm telling you, people are doing tax advisory even without going to class like you. Huh? And it is so bad that guys like you who are already in class, you fear to start. You're going to learn on the job. If you feel you don't have experience, I am your mentor. Already, I am here. Get clients. When you get clients, call me. I'm stuck here. I'll guide you. As long as you pay me. eh? So you cannot start because you have experience. Where are you going to get experience? Nowhere. You want to get experience? Start today. Look for clients. Stop those things of moving in office to office. You are hawking your CV. This is my CV. I want a job. Yet people can give you. I'm telling you, I've done it. I am a live example. I have ever made a claim of 1.2 billion for an Indian. They were doing this power working with the government of Uganda, and they had VAT claimable from URA 1.2 billion, and I got my 10% clean money. In fact, before I started, they gave me 50%. Yes, we had an agreement that if I fail to pull out the money from URA, I refund the 50%. So where are you going to get, which job are you going to get that kind of money? Where you get 120 million in just 2 weeks or 3 months? Which kind of job? Even if it's an MP job, you stand in a constituency. I've seen MPs now pulling out, crying, they are in debt. This is the best career you can. So please, experience is not a barrier. It's just in your head that I don't have experience. Usually these are the things that happen to us, that in your head it's running. You don't have experience. Yet already there are people at NASA Road who are doing it. They have never been in class. So you are in a better position to make a very good tax advisor, tax agent, tax consultant. Okay? Start today. Start by filing a return or registering someone for the tax identification number. You should start from there. So, members, I'm just encouraging you. The field is so virgin. There are no tax agents, no tax consultants that are fine-tuned like you guys. So you have to start today. I have shared the questions. The questions are there. Okay. So we are going to start with this Kazinda. Now, the first set of transactions right here. are going to help us in building the output or sales schedule, okay, for our return. Sales schedule. We shall start from there, then we shall move to the second part. Maybe the other thing that we need to take care of is VAT inclusive, exclusive. That is also important. The note, this one down here. As we do the computations, all sales are VAT exclude. VAT is not there. Purchases and expenses are VAT inclusive. So the rest are going to be different. If it is VAT exclusive, then we shall use 18%. If it is VAT inclusive, then we shall use 18 out of 118. Because if it is inclusive, it means the figures have VAT included. So 18 out of, VAT is on value added. On 100%, 18% is added. So that is why it is 118. Okay, so we are going to first handle 1, 2, 3, 4, 5 transactions here. Post them in our VAT return. I'll be calling it a return. Okay, so what do I need to do? I'm going to share this. Of course, at this point, we assume you are okay with the schedules. You know what is VAT exempt, what is VAT zero rated, what is VAT standard rated. That is important. So I have this, I would say, is my return. You give it a title. Then, of course, the month. Don't mind about the month. It's a mix-up, But just know, I'm using the same figures. And I'm going to use the same, I'm going to use the current VAT law. So the first thing we are going to do as per the arrangement of the tax return is Schedule 1. Schedule 1 are the sales, and that is our output tax, VAT on sales. So those are the 5 transactions. We are told the company sold general merchandise to the tune of 350 million, sold fish to the tune of 40 million, sold cows to the tune of 50 million, general merchandise, that is 150 million, exports, that is 300 million. Given the fact that the exports were fish, I will simply put exports, because whether it is fish, whether it is furniture, whether it is shoes or bags, whether it is cows, as long as it is exported, it becomes an export. Now, the total supplies, as per the activity or exam type question, if I add up all these, I get 575 million. Now, general merchandise is standard rated outrightly. We are told this is VAT exclusive. There's no VAT in here. Fish. Where should I put fish? Standard, zero, exempt. You can make suggestions. Standard, zero, exempt. Where can I put fish? You are the ones to cram those schedules, eh? Yes, I expect you to tell me, because you are going to sit the exam. So you must have anybody? Sale of fish, exempt, standard, zero. suggest. If you want, you can unmute yourself. Feel free. Talk in the microphone. General merchandise is standard rated outrightly. What about fish? Okay, let's proceed. Anyone to suggest sale of fish? Where can I place this? Fish must be exempt, right? Fish is exempt, is an exempt supply. Unprocessed agricultural products, third schedule. Sale of cows, this is also exempt. Unprocessed agricultural products, third schedule. General merchandise keeps at 18%. Standard rate. Exports, you know exports are zero rated, right? Yes, at least for exports, everybody knows these are zero rated. So 18% of 35 million, that gives me about 6.3. Exempt is 0. This is also 0. This is 27 million. 18% of 150 million is 27 million. Then this is also 0. So that gives us a total of about 3.3 million. I'll be sharing this. You don't need to write. I'll share this, no problem. So before we proceed to the next schedule, this is the completed day output tax schedule. We need to determine the percentage of taxable versus exempt. So I want you to take off 5 minutes to calculate for me the percentage of taxable supplies. Actually, just give me the percentage of exempt. Yes, because the exempt are the ones which are dangerous. We need to know whether the exempt, just add this 450 over the 575. What is the percentage of exempt? 5 minutes. Share with me in the chat. We proceed. Yeah, should be able to get 15.65%. If you get the 90, that's 450 divided by 575. Is that okay, Praise? Are we clear there? Just get 90 million over 575 times 100%. You get the 15.65. So friends, make sure in the exam you give all these explanations. This one here, Kazinda Enterprises cannot claim all the input tax since his exempt supplies exceed 5% of the total supplies exclusive of VAT. So after that, we of course now conclude that Kazinda should opt for the general apportionment method. He cannot use the standard alternative method. We shall be looking at the standard alternative method next week. And then of course support it with an exam type question. So his percentage of the taxable supplies exceeds that of the exempt supplies. Yeah, I'll come back to that. Let me put it in yellow. Because why am I talking like this? You need to know why is it that he cannot use the standard alternative method, the other method. He cannot use it because his percentage of taxable supplies exceeds that of exempt supplies. So in our language of tax, we say Kazinda Enterprises is not disadvantaged. Is not disadvantaged. We shall be looking at that much more. So when you're done with that schedule, as per the return, remember, I've shown you the return that you separate. Please, in the exam, do not disadvantage yourselves by just, you see some people calculating after this, he just cashes another as if this is just theory or this is tactical. As you have seen the return, they have split the schedules. First compute schedule 1. Give us schedule 1, output tax. Then give us schedule 2, input tax, which is the VAT on purchases and expenses. So what I'm going to do, of course, I'll take you back to the question. We see what we are going to do. There are so many things here, transactions in regard to the purchases. The first one, we see that he imported goods from Japan. There was transportation of goods from Mombasa to Kampala, 10 million. Local purchases of 70 million. Salaries of 15 million. Repairs and maintenance of the saloon car, 5 million. Telephone bills of 1.250. Medical bills of the staff, 2,250. 2,550. Office stationery, 1.3. He also returned to his suppliers local purchases amounting to 7.5. During the previous 2 years, he had accounted for input tax on a sale of 25 million, but this debt has since gone bad and therefore no hope of recovery. So how do we treat bad debts on the return? We are going to see that. This figure is VAT inclusive. He also paid for water and electricity charges for the month of March, amounting 450. For the month of April, amounting 550. And also paid in advance power consumed in May, amounting to 650. Other overheads are 60 million. Don't mind about the months, but here the whole issue is how do we treat prepayments? How do we treat because as you can see, there is electricity for the previous month, and then the electricity for this month, and then electricity prepaid for the next month. So we are including all that here so that you can know how to treat that. So we now build our second schedule for the purchases. Input tax. So we begin by showing the supply, we show the amount, the VAT rate, we show the VAT itself in shillings, and then our remarks, why we are treating them like that. I'll begin with the imported goods from Japan. The taxable value is 75,625. I'll be showing you that in working number 1. VAT is at 18%, and of course that gives us 13,612. We know that imports are standardly rated. Next, we have the transportation of goods, which amounted to 10 million. Transport is zero rated, that's 0%. So VAT is 0. This is a zero rated supply. Next, we have local purchases to the tune of 70 million, but inclusive 18 out of 118, which my calculator gives me 10,677. You prove that. That is standard rated. Next, we have salaries and wages. You know this is out of scope VAT. And again, in the return, you saw out of scope VAT. So there's nothing. You don't even talk about VAT here. Don't even talk about it. Outside the scope of VAT. Next, repairs and maintenance to the tune of 5 million. This is not claimable, so you cannot claim VAT on repairs and maintenance. Remember, we also talked about this in our presentation. I hope you still remember. Then we have telephone bill. I talked about it, that for telephone, you only claim to the tune of 90% because research has shown that if they put money on your phone, 10% of it, you make calls outside official duty. So you can only claim VAT on 90%. So that is VAT inclusive, 18 out of 118, which gives us 171, 610. Only 90% of input is claimable. Medical bills to the tune of 2,550,000. This is an exempt supply, so I don't talk about VAT on medical. Office stationery, obviously, this is standard rated. This is to the tune of 1.3 million. VAT inclusive, 18 out of 118, which gives me 198. 305. Standard rated. Next, water and electricity for the previous month. You see that? This is 450. However, given the fact that it is for the previous month, you have to amend. You see that? This one is a return for March. You see? The return is for March. So if you're filing March and there is electricity for last month, you have to amend. We cannot bring it to March. So that's why we are saying that the tax point is February, not March. The tax point is Feb, not March. I hope that point is there. Well captured. However, the water and electricity for this month, the 550 VAT inclusive, is going to be included in the return for this month of March. Input is accounted for now. Time of supply is now, right now. Okay? Yes. Then we have electricity for the following month, because if we are filing for March and you have already paid your bill for the following month, you are wants the money right now. So you can include it in this return, 18 out of 118, which gives me VAT of 99,152. Tax point is right now when the payment is made. Then we have seen that there was a return. This is a credit note. It happens in business, it's okay. You can return back goods. Maybe they are physically damaged, or they're in excess, or they are expired. Any other reason, ask for the credit note. You will be given a credit by URA. So that's a negative that's going to offset your liability. And of course, I hope you know how to input these returns, these credit notes in IFRS. If you don't know, enroll for our course. There is a free course. You're not going to pay for it. There's a free IFRS course. Just go to our website, enroll for it, and learn how to do things in IFRS. Simple as that. We have seen that there was a bad debt. Someone was refusing to pay the money. We tried to make calls, tried to run around. Money was never paid. 25 million. This was, of course, VAT inclusive, 18 out of 118. And it means that we have to be refunded our 3.8. Remember, if you fail to collect money, we talked about it when we were talking about accounting for VAT. We talked about the accruals method of accounting for VAT. Accruals requires that you put all the transactions, those where you receive the money, those where people have not paid you. So you find yourself remitting to URA money which you've not yet collected. So if you fail to collect it, tell URA, hey, give me back my 3.8. This money was never paid. The guy was not genuine or got problems, bankrupt. Give me back my money. So you get back this money. The output tax is accounted for on the bad debt and is claimable. Other overheads to the tune of 60 million. This is inclusive, 18 out of 118. That is 9.152, standard rated. Now, there is another column I created here that you're going to find where I give the status is VAT claimable. Because yes, you paid VAT, but is it claimable? So for the imported goods, yes, the VAT is claimable. Okay. Oh, what am I doing now? Let me just redo. What is here? Claimable. What about this? This is zero rated, nothing to do with that. What about the VAT on the local purchases? Is it claimable? Yes, claimable. Are we supposed to do this in the exam? Absolutely. Absolutely. At this level, we expect you to do much, much more. Remember, we are sending you to the field. So what about this 171 on the telephone? Is it claimable? Yes, it is claimable. Does URA verify this? But absolutely. don't tell them stories that you see the date went bad, we failed to collect. Where is the evidence? Where is the evidence? Did you call the person? Actually, those guys are so good that they can actually tell you that let us collect it. Let us collect the debt. Give us the name, the house, the shop, the street where this person is. We shall collect the money for you. I told you, URA is your partner in business. The day you get it in your head is the day you get peace. Don't cheat. And this is a person you should not cheat. Don't try. Don't try it. Do not try it. URA has 30% stake in everything you do. Understood, George? So don't. It's like telling this is the same thing as telling your parent, you paid for my fees, but I failed to study. This is a guy who has 30% in your business. So I've had those cases where you are able. Can you imagine someone telling you that you give us the details? We are going to call the people. We are going to call the people and ask them. Actually, it's the school. The school we are showing URA. You see, the students fail to pay. These students, and then you know what the officer was telling me? Actually, the manager, uh, domestic taxes. We know your school. People don't study for your school. There's no way. Students fail to pay. Please, this is not acceptable. We had taken to them a list of bad debts that you see these students got problems, they did not study, dropped out, and they give us the names and the telephone numbers, and I gave them. They tried to call, but the next time I went there, I said, okay, it's true. Let us let it go. Let us let it go. I told them that's how serious they are. Don't just begin those stories. Bad debts. Bad debts written off. How did you write them off? Uh-huh. What about this office stationery 198 claimable? Yes, that's going to be claimable. What else do we have? The 83.99, are they claimable? Absolutely claimable. What about this negative here? Okay. What about this bad debt? Yes, that's claimable because the debt went bad. We try to pursue. What about this? Yes, that's claimable. So where I have put claimable, I think there is where I said not applicable, not claimable, something like that. Yeah, can't claim. This repairs and maintenance, you cannot claim. Then this is not applicable, salaries and wages. So at the end of the day, I need to show you this working one, how I come up with this 7.5. So simple, customs valuation, the value of imports, we get the CIF value, which is given in the question as 55 million. Import duty is at 25%, which is 25% of 55 million is 13.7. We add that to get the total, which is our A. On that A, we charge excise duty, which is 10%. That is absolutely 6.8. We get total B, which is our taxable value for VAT purposes. So that's where I get my 75.6. So customs valuation is assumed at this stage. I think everybody here has pre-done customs to some extent. Juliet, have you done customs to this extent? Praise? I think Gloria is okay. George is okay. Brian is okay. Brian, I see you in customs. George, I see you there. I'm not sure about Juliet. Gloria, I'm very sure. Praise, I'm not sure. So customs valuation, just very easy. CIF value, add import duty, then add excise duty if it is there. Then what you get is what you charge for VAT. That's why you have our 75,625. Then finally, we now go to our schedule. You remember? there are three major schedules we expect from you. One for output, another one for input, and the last one for VAT payable. Speaking directly with the return, the CIF value will be given, Juliet. We shall give you the CIF value. Will be given, at least for VAT purposes, we shall give you. For customs, you may need to calculate it, but for VAT, we shall give you. What you need to know is that on the CIF value, I add the import duty, get the total, add excise duty, get the total. Okay? Finally, we now get our VAT from Schedule 1. Remember our VAT return? Get the 33 million, that is your output, bring it here. So we are saying total output, that is the 33 million. Then first get off the input. Get off the input before you pay to URA. Your input is to the tune of 36, but I'm going to remove this bad data, 36.6. However, Kazinda cannot claim all of it. You know why? He has a percentage of exempt, 15.65. There's a percentage here. So he cannot claim all of it. He can only claim 15%. Sorry, he can only claim to the tune of 84. You can only offset to the tune of 84. You cannot claim the 15.65, the exempt. So that's why you see that I'm going to deduct only 84.35%. Now, in the brackets, you can see that I'm removing the bad debts. That is what I'm supposed to do. I don't know whether anybody can give me that explanation, but obviously, the bad debt cannot be apportioned. You have to claim 100% of it. So that is, isn't that our 383? No. That is 27. The input to be offset is 27. Then we have our bad debt, which must be claimed. Remember, this is what we paid to URA, but we failed to collect. So URA has to give us everything without apportioning it, because it's not out of a purchase or expenditure. So we cannot apportion it. At the end of the day, the VAT payable to URA comes to 1,782,292. So that is what our tax return is showing, and that's what you're supposed to pay to URA. Okay, so basically that is it. Try out question number 2 in your free time. Next week, I think I should give you an exam. You've done a lot. So I should test you a little bit to see whether you are steady, huh? Should test you a little bit. Let me share the solution, all of it. If you have any problem with it, just let me know. The lecture